A recent survey by Motilal Oswal Asset Management Company found that retail investors in India are increasingly warming up to passive funds. From 20,000 crore in December 2015, the asset under management of these funds has grown to 7.6 lakh crore currently, and they contribute about 17% of the industry's total asset under management. In an interview with Business Standard, Pratik Oswal, President, Passive Funds at the Fund House, says that retail investors are opting for these funds because they find them easy, economical, and effective. He also dwelt at length on the major categories where these funds are finding takers. Do watch this interview to learn more about the growing popularity of passive funds. Good evening, Mr. Oswal, and welcome to our show.
Hi, good evening. Thank you for having me here. Looking forward to it.
So you have done a survey on passive funds, which shows that retail investors are warming up to these funds. Before we talk about the findings of the survey, I wanted to ask you a question about the nature of the respondents. Like, how many respondents were there? Were they all from your AMC, or were they outsiders also? And was it an online survey or an offline survey or a mix of the two?
So this was an online survey. It was open for about 4 months of this year. And it's a combination of our own customers and also external customers. So this is not biased towards our customer only. So we kept it open, and we obviously put it on social media and put it on all our distribution platforms. And we got 2,000 responses over 4 months. And this is just the sort of result that you see of those responses.
Would you have some numbers that could demonstrate for our viewers how passive funds have grown over the past few years?
Yeah, definitely. So, I think if you look at passive funds, you're looking at a category, ETFs and index funds, so I think in terms of growth, if you look at December 15, which is about, I think right now, 7.5 years ago, passive funds were merely 20,000 crore in terms of total assets. And today that 20,000 crore has gone to 7.6 lakh crore. So that is the sort of growth that we've seen in passive funds. Even in terms of market share, when it was 20,000 crore, the market share of passive funds were about less than 1.5%. Today it's gone to almost 17% of total AUM of the mutual fund industry. So I think not only in size, but also in market share has it grown, the entire landscape. And this is not only equities, but, also fixed income, international equities, commodities. So there's multiple asset classes that customers can now invest into via, index funds, ETFs, passive funds.
And of the total AUM under passive funds, what is the contribution of retail investors? I'm asking this question because EPFO is such a big contributor to passive fund AUM.
Yeah, so I think it's so all these estimates that we have are obviously the AUM is sort of the passive funds AUM is that's accurate, but what we do is at least in our research desk, it's we can't avail information as to how much EPFO is investing and how much every month. It keeps varying. So this is more of an estimate. We use cash flows from different mutual funds to estimate what EPFO flows might be in. But again, it's very hard for investors today to see, again, to have an accurate sort of number about what the retail is, what HNI is, what institutional is, what EPFO is. But essentially, if you look at the large cap sort of universe, and this is where majority of the passive flows are, I think you're looking at close to 4.2 lakh crore of assets. Approximately if you remove sort of EPFO, you're looking at net flows on the industry of about 43,000 crore over the last I would say 5 years. So I think from about 1.8 lakh crore of sort of positive inflows of money coming into large cap passives, approximately 43,000 crore is retail, and the rest is EPFO. So I think majority is EPFO, but even 43,000 crore is a pretty large number, because if you look at actively managed mutual funds, that number is to about 25,000 crores. So I think still you're looking at double the AUM of what has come into active mutual funds that has come into passively mutual funds in the large cap space. That's not including ETF.
Now, this survey mentions three reasons why passive funds are catching on: easy, economic, and effective. Could you elaborate on these reasons?
Yeah, so this is something that we've coined as a mutual fund company. So what are the benefits of investing into index funds? And I think there's three broad benefits of index funds. One is obviously very easy. We believe that index funds, and even our survey shows us that one of the big reasons to why people invest into index funds is because of how simple they are. If someone's looking at a large cap fund or a mid cap fund, instead of trying to choose between the 40, 50, 60, 100 funds, you can just buy the index, and you're basically making your life easy. Also, passive funds don't underperform the index. So I think a lot of our investor base who's looking to invest for say 25, 30 years, it's very hard for you to select one specific fund. So that's where passive funds make it very simple. The second one is economic. I think economic means passive funds tend to be a lot more low cost, and this is one of the primary reasons to why people invest in index funds. When your expense ratio is very low, more of your money is invested in the underlying stocks and the underlying strategy. So I think I think low expense ratio is a very big draw towards people investing in passive funds. And effective is basically returns. What we've seen over the last couple of decades is not only passive funds have very long track record, 15, 20 years plus, they're also very effective in terms of wealth creation. I think there was a discrepancy between passive funds and other funds. But today, I think if you look at the returns, at least past returns, I think they're pretty much very similar. So I think very effective for wealth creation, very, very economical and also easy to understand. These are, I would say, three of the primary reasons to why most investors looking at index funds.
So my next question is a bit more of the same. One point that has contributed to the popularity of passive funds is that actively managed funds are finding it very difficult to beat the index, especially on the large cap side. Do you expect this trend to intensify as the years go by, as has happened in the US and other developed markets?
Yeah, I mean, honestly, yes, on average, it's much harder to beat the index than it was, say, maybe 5 to 7 years ago. The market has become a lot more efficient. There's a lot more people who are bargain hunting. The number of analysts covering a particular stock has increased dramatically. So yes, I think trying to find low valued or good value stocks have become a lot more difficult today than it was, and that's why you're seeing that low cost passive funds are doing a lot better. I think looking at examples from the West, you do expect this trend to continue going forward. Although having said that, I think India is at a very different stage. US is a lot more developed than India is, and they've had a much larger history. So we do believe that yes, there is opportunities for both active as well as passive funds to do well. I think right now a lot of our investor base is looking at something simple. And I think adopting simple funds is a lot easier when you know that performance is not going to be very much different from the index, which again is very well in terms of past returns. So I do agree. I think yes, this trend will continue. Looking at how things are in the West.
So on the equity side, most of the money goes into large cap funds. What are the reasons for this?
Yeah, so generally large cap funds tend to have the most flows, because they tend to be they tend to have the most demand as well. I think if you're looking at equities, the large caps tend to have the highest sort of relevance, lowest churn, and also the companies are probably the safest out of the entire sort of large cap, mid cap, small cap universe. So I think generally, even if you look at geographies outside of India, the S&P 500, for example, is a large cap index, and that controls majority of passive flows. So I think even in India, I think large caps have done very well in the past, and you expect most of the flows to sort of consolidate in large caps. However, obviously, there will be, sort of also flows coming, mid and small caps, in multi-cap funds. But I think it's safe to assume that, large caps are very popular. When it comes to also, institutions, pension funds, they have a mandate of only investing in large companies. companies that are very credible and companies with stable business models. I think large caps are much more favorable. So I think if you look at the quantum of flows, even though retail might sort of buy and sell different type of funds, sector funds, or I think thematic funds, the bulk of the flows comes from institutions, and they tend to prefer sticking to large caps.
Is it also because the majority of large cap funds are finding it hard to beat the index, whereas fund
Oh,
managers are perhaps performing better on the mid and small cap side?
no, I don't think so. If you look at overall flows in India also, the mutual fund industry, large caps would have the highest amount of AUM. If you look at flexi cap schemes or multi cap schemes, they all will be large cap biased. I think it's more to do with, I think investors investing in stocks would, any investor today, me, would first look at allocating towards large caps before mid and small caps. In fact, your core allocation will probably be in large caps, followed by mid and small if you have the risk appetite. So I think equities, anyone investing in equities, cannot just stay small and mid. So I think overall, yes, large caps will be biased, for I think very similar other markets, which is why also obviously in passive funds, I think, yes, obviously the performance of large caps tend to be, most large cap funds are underperformed. So that's why passives have grown. But I think overall, we feel that, I think it's more to do with investor preferences towards large caps.
And on the debt side, target maturity funds have attracted a lot of flows. What accounts for their popularity?
Yeah, so target maturity funds, I think they are popular, I would say, for two reasons. Again, low cost. The second one is tax advantages, which have recently been taken out. So obviously the segment will not be or not grow or not be as big as what people had imagined this time last year or even 6 months ago. So I think the pre and post tax of target maturity funds versus something like an FD or another fixed income instrument, there's a huge difference. I think that's why you had a huge craze over target maturity funds. I think it's a category which was zero. Passives in fixed income was not only was not a category itself in December 18. Now it's 1 lakh crore plus. So I think definitely there is a lot of innovation there to be made in fixed income. The first innovation was target maturity funds, and I'm very confident that there will be a lot more innovation in fixed income. India tends to be a little more of a fixed income sort of a market. So definitely there's a lot of opportunity there. And obviously target maturity has had its run, and we hope that it continues. But we feel that there's a lot more innovation in the pipeline.
Another category where passives have caught on is international funds. Why have investors preferred the passive route when diversifying internationally?
Yeah, so I think international funds or international investing has also been a recent phenomena. Again, not really a space which was popular 5 years ago, and now it's again popular. Unfortunately, now it's popular, but the industry is not able to handle the flows because of the limits put in by RBI. But I think if you look at the last 5 years, I think there's been a lot of interest. The reason why international funds, passive is sort of, preferred is one, because I think a clear winner in terms of performance, passive funds, at least in the West, have performed really well, number one. Number two, I think, we understand India, but, an average investor, understand the Indian markets, but it's much harder for us to understand what's happening in the US or Europe or Japan. So I think passive funds make, again, that simplicity becomes a lot more important when it comes to in markets where we don't understand much. So that's why passive funds have been preferred. I think also, I think the cost associated with running a passive fund is much slower, and so I think that's one of the again reasons to why international funds have sort of got on a very big way. Yes, a lot of it has to do with the past performance. So they've also performed really well in terms of the track record. So that's one of the reasons to why there's been growth. But I think the major reason is because of diversification. You're basically buying an asset class which has a very low correlated risk with Indian equities. You're buying the US dollar, which again, is a great asset class to have, especially I think given that the rupee depreciates by 3 to 5% every year. and I think you're buying global brands which are now becoming synonymous with Indians. So overall, I think it's a good trend, and I think it'll probably continue to stay. Obviously, the industry is waiting for new limits. So once that happens, we'll be able to accommodate investors looking at this vertical
Now,
category.
there are two developments that could possibly impact the popularity of international funds. One is the tech meltdown that happened last year, because prior to that, there was almost a 10-year bull run in US equities. And the second is that tax changes that affected debt funds will also affect these international funds. Do you think these developments will affect the popularity of international funds?
No, I think tax. I do believe that investors. I mean, maybe I think a lot of ultra HNI investors are looking at alternative ways of investing abroad because, as you said, the tax thing has come in. So I think yes, a lot of investors are looking at LRS as an option. But however, a lot of investors still prefer the simplicity of investing in mutual funds. It's the lowest cost. There's no TCS. There is obviously you don't have to worry about your transparency. So I think in that sense, mutual funds offer a lot more simplicity when it comes to international investing. When it comes to tech meltdown, honestly, that keeps happening. In fact, what's strange is it's come back. This year Nasdaq is up, I think 40% plus. So I think the performance keeps going up and down. Yes, I do agree that a lot of the sort of flows came in because of tech, but for example, our AMC, we had about almost 1.5, 2 lakh SIPs that were coming in on international funds. So I think there is a savings mindset also where people want to build that 5%, 10%, 15% of their portfolio towards international allocation for the diversification, which I think will probably continue for a long time, because I think that's been a major driver for adopting international funds. It's not only just returns, but also people feel that it makes sense to have an allocation, say 10% or something in your overall portfolio.
One of the key findings of your survey was that Indian investors prefer index funds over ETFs. What are some of the reasons for this?
Yeah, so again, unlike the West, where ETFs have an inherent tax advantage, clear tax advantage. So out there, it's almost, I would say, um, you know, I mean, maybe a better word for stupid to invest in index funds. I think in India, there is no tax advantage of ETFs over index funds. They're both the same. So that's one. Second is, I think in India, ETFs don't have a lot of liquidity. Impact cost is high, and I think also people do not have that mindset of saving through the demat account. So I think mutual fund investing is a lot easier. You can set up SIPs a lot simpler with mutual funds, and I think you don't have to have a demat account. And also, you don't have to worry about buying high or selling low. You're basically buying the end of day NAV, which has a very accurate figure of what your investment should be. So I think the simplicity of index funds is one reason why most investors have adopted index funds over ETFs, which is what also we've seen in our business as well. I think so that's there. I wanted to make one more point. Um, yeah, also I think compared to ETFs, where a lot of our investors want to play on a specific price. Say they want to buy the price as of 10:30 or 11 o'clock, then obviously ETFs make sense. But I think at least the retail prefers index funds. There's more AUM in ETFs because ETFs are preferred by family office institutions, pension funds. So I think there'll always be, in my opinion, a lot more AUM in ETFs. But I think broader demand will happen in index funds. Even in India, tends to be a lot more distribution-based an economy. So index funds offer that scope of giving distribution or commission to our advisors, so they are able to I think sort of recommend this to their customers. So that's also one benefit of index funds over ETFs.
Now, there are so many index funds, ETFs. how does one make a choice? What are some of the key criteria one applies, especially when choosing an index fund?
Yeah, so the main criteria, at least in our opinion, is convenience. I think both are very similar. The returns are going to be pretty much the same. I would say investors should go for what they prefer in terms of convenience. If they prefer buying ETFs through the demat account, then they should go for that. If they want to buy index funds, if they prefer buying mutual funds, then they should go for MFs. I think in terms of options, there's a lot more option in India when it comes to index funds because they're much easier to manage. So I think for the AMC, for the asset manager, index funds are easier to manage as opposed to ETFs, which is why you have a lot more index fund launches than ETFs. But again, for an investor, I think they should go with convenience. I think whatever they find convenient is what they should go. If they're not sure, then I would say index funds are probably a lot more simpler to set up SIPs and to buy and sell.
I have finished with my questions. Is there anything you'd like to add, say, about the survey? Were there any findings in particular that kind of surprised you?
Yeah, so I think a couple of them. One is 3 out of 4 do SIPs. So I think that's again that's a great statistic. I think again very special to India. SIPs are not very common anywhere else in the world. I think one of the biggest innovations, and it's probably the best form of wealth creation for retail investors. So I think that surprised me as to how many people responded with the fact that they do SIPs. The second is also, I think, the fact that 80% look at passive funds for more long-term perspective. I think the reason why that's surprising is because in the West, a lot of people tend to trade on ETFs, tend to take directional calls on Nifty, Bank Nifty, that sort of stuff. I think it's good to see that people are looking at passive funds from more of a savings mindset than speculation mindset. So that's also something which sort of positively surprised at least me when I looked at the results.
Thank you, Mr. Oswal. I hope you keep coming out with such surveys so that we get to know more about how investors are getting into passive funds. Thank you and have a nice day.
Thanks for having me, and I appreciate the time and look forward to the next one.
Goodbye.